All right, welcome to the Eitel Insights podcast, episode number 3. Thanks again for joining us. We took a week off last week, and we've actually been quite busy, and we'll explain what we're up to since then. But we're right back on schedule today, and we've got another loaded episode for you. So just taking a bit of a recap, we've actually got quite a resounding, kind of resounding feedback from us. A lot of it is very positive. A lot of people have been very thankful about the information we've given out. Naturally, there's incentives that are being aligned on both sides. So some people who are owning properties, they see a little bit of the apocalyptic message that we're conveying to be a little bit unnerving. So they've sent us some feedback and requests for more information. And of course, people who are looking to enter the market, they're actually getting quite excited because they see that there might be opportunities ahead to get a good deal on a place that they've been eyeing for a while. Now, people invariably ask us, what is Eitel Insights? Is it a podcast platform where we essentially give out cool free information? And I mean, that's obviously one component of what we do. But just so people are aware, Eitel Insights is an analytical firm that sells analytics. It's as simple as that. The way that we make our money is we give out information like we do on this podcast. We have a great time doing it. For us, there's a lot of intrinsic reward in doing these podcasts in that, we get to hang out and talk about topics that interest us. But ultimately, the way Eitel Insights makes money and builds its client base is through the reports that we sell. So you'll notice that if you go to our website, eitelinsights.com, people looking to get a little bit more granular information so they can make confident purchasing decisions can buy reports that are priced at about $250, and I think they can buy an analytical report to their specific region. So, for example, if I'm a potential buyer or I'm a condo developer or I'm a housing developer that is eyeing the Tri-Cities, Port Moody, Poco, Coquitlam market, and I want to get a prognostication on where that market's headed over the next year so I can optimally time my buying decisions, I'll buy an Eitel Insights report. And in the report, there'll be rich information on when you should be buying, when you might want to hold back, and when you might want to take advantage of something that might be a pretty juicy opportunity. So in case anybody was confused, Eitel Insights is a real estate market research firm, and we do deep analytics that hasn't been done before. And we apply a lot of kind of stock market trading techniques to the real estate market, but obviously it's very nuanced and customized specifically for the Canada-wide real estate market, and it's broken down by region. So apologies for the commercial there, but we did want to actually answer questions about Eitel Insights and what we do. But of course, a lot of our bread and butter is information dissemination, whether it's through different media platforms, whether it's through our podcasts, or whether it's through the newspaper articles that I'm sure you've seen about Eitel Insights by now. So with that out of the way, let's get right into the meat of the podcast. Dane, how's it going?
Excellent, Andy. That was a nice commercial. I could have paid you a little bit more.
yeah, for sure. That was off the cuff too, but we're obviously both very excited about Eitel Insights, where it's heading. We're growing very quickly. Our client base is expanding. So going back to why we missed last week, the reason we missed it is actually there's been a deluge of media interest for Eitel Insights. There's been people knocking on our door. Some of them came through the podcast, and obviously some of them came through grassroots efforts that we've been taking just through your traditional social media platforms.
Right.
But Dane, give us a bit of a breakdown on what you've been up to the past couple of weeks. You were recently featured on a couple key platforms. So what's been going on?
Yeah. So, I mean, first of all, why we had a little bit of a delay as well. I mean, we wait for the new real estate data. So rather than having 3 podcasts, kind of saying the same data about April, now we got the new May data that has come out, so we can kind of get into that today. And we did release, our usual market updates to the media, and we were inundated with requests. We got a very nice feature throughout News 1130, kind of giving us credit for actually calling the top of the market and, alerting the public and especially our client base that it might be a time to take advantage of some selling opportunities because they wouldn't be lasting too much longer. And I can definitely assure you, with as we get into this data, everyone that has sold back then is very grateful compared to the last data point here that we just experienced. We've been featured on the Simi Sara show, News 1130, as I mentioned, and as well with Money Talks. And we actually have some more content coming out next week on Money Talks as well. So you can kind of check in with their website, with all of the media that does cover us, and of course you get all the information on eitelinsights.com. One other piece, we're actually just working with some pretty interesting client base, and they're looking for continual updated information rather than just the one-off report. So we're doing some backroom work and getting all that ready so that the public can become our clientele, and our clientele will have the best ongoing information rather than just maybe a one-off report where that might be satisfactory to a potential purchaser or seller at that period in time, but somebody that's a continual investor and looking for areas to optimize in, that this would probably be something that'd be right up their alley as well.
Okay, cool. So let's get into some content. And you mentioned that there's been an update in May. New data's come out and you've run the analytics on it. One thing that was interesting to me anyways is that looking at the charts, there seems to be a little bit of a rebound. So the people who aren't aware, a little bit of a background on this. In March of 2016, we had our peak sales volume. So roughly about 2,200 detached units were sold in that month. And that was in the height of the frenzy, right? When Vancouver was untouchable. And since then, in the stock market, and I learned this term from you, we've seen falling knife behavior, which is basically a dramatic drop month after month in sales volume. But just recently, in the late April, May timeframe, we've seen a bit of a rebound. This seems somewhat contrary to what we've been talking about the past few weeks. So give me a little bit of insight into what that rebound is. Is it something that is inconsistent with what you've been expecting, and where do you think that rebound goes?
Yeah, perfectly phrased question, actually. No, it's right in the line of a trajectory. And as you stated, you and I cover the stock market, and we talk about this in our kind of fun time. And but with the real estate, you can't really have a proper true falling knife because data points come out on a monthly basis, as opposed to a stock market where literally they can put a halt to a stock and reopen it at a significant discount. So it's a little bit of as close to a falling knife as you can see in a real estate chart, which was the sales from 2016 till basically May of 2019. Now, why it broke out of that trend was because you can't consistently have abysmal sales numbers, right? I mean, in 2019, January, we saw 344 detached properties that sold. Now, that's pretty darn close to the absolute worst time of the recession of 2008, 2009, when in January of 2009, there was 292 sales. And it's kind of interesting because this is the great time of the year. May is real estate's Christmas season, if you will, right? The weather's warming up, the sun is out, the trees are blooming, the grass is getting cut, properties are looking nice. So this is usually the best time to sell at reasonable prices. And that's true again this year, which is great because, as we say, Vancouver is always a long-term, excellent place to invest. However, the best is still yet to come if you're looking for the best bang for your dollar. So, as we say, the 918 sales actually broke us out of that torrent downtrend of the falling knife in the sales. And it's the highest number of sales in the past 12 months since May of 2018. So that's a good indicator. And I can see how some people could be led to believe that this is a base, a solidifying factor. However, with our analytics, we see that there is a prolonged conservative downtrend that will inevitably be tested and will actually force this market lower longer. Not to mention, we're still, the forecasted indicators such as our relative strength index and our technical prices still state that there will be a day of reckoning upcoming here, likely within the next 2 or 3 quarters, 4 quarters at the most. Likely 3 quarters at the most, actually. So, we don't see any reversal of our fortune because of this 1 month of sales. It's a great thing for the market, and truthfully, the way we see it, rather than a stabilization, it's more of a realization that the market isn't what it used to be. So the new sellers, the guys that are actually starting to say, I need to sell, they're starting to be realistic, listening to good advisors, listening to Eitel Insights, listening to the leading indicators rather than chasing the market all the way down. So the old adage, a good property will sell. Now, what makes it a good property? Well, it doesn't really matter the condition of the property. As long as it's properly priced, someone will say that property's good, right? It can be a shack that hasn't been maintained forever, but it's good value for somebody at a particular price, right? You and I would definitely take it for $20, right? Sure. I mean, somebody wants $1 million for it, and somewhere in between the truth lies, right? So what makes a good market price is it's a saleable entity. Now, what we're saying is going forward over the next year, 2 years, that good price will continue to be at a lower price point. So you do have to lead the market. And like I say, that's what we're seeing. We're starting to see more serious sellers. And you still have some buyers that are serious. I mean, it's not like it's a totally dead market. It's just a changing market. And literally where we are, the average sale price for the detached market, once again, here in May, was $1,586,000. Now, that's significant for a number of reasons to me as an analyst. I mean, it's right at that middle threshold, right around that 1.625, and I can really see us maybe even creating even more of a divergent trend going forward until we meet the first quarter of 2020, which will likely be the day of reckoning. And once again, I can see why somebody might see that as stabilization, because it's not going much lower than what the base used to be. However, like I say, it's 1.586. It's not 1.625, which used to be the base. Kind of signaling that 1.625 didn't prove itself worthy. 1.586 isn't going to as well. And we do trend lower ultimately with these divergent trends, as we'll put up on the podcast, will show out and play out.
Right. Because this rebounded from a pretty bad low recently, and that low was actually not seen since the Great Recession. And that's correct, right?
Well, yes and no. So it was the biggest, most significant drop we've had in a while. In February of this year, we reached the sale price of $1,472,000. Now, what's kind of cool about that is we called for that price drop. In our initial article back in 2017, we said in 2019 prices would be below 1.48. 1.472 is pretty accurate. So now what's significant about that move, once again, that was the first time since the foreign buyers tax announcement we had a sharp reaction down, and then the market peaked after that, kind of showing that the foreign buyers tax didn't have the impact everybody thinks it did. And so for it to break that 1.625 mark on an average sale price, psychological value, it had to do it in a nominal way. And so it didn't just break it at 1,610,000. It went all the way, Verstunken, down to 1.472. And then we see a dead cat bounce, because that's not really the market's value at that point in time. And so it came back up to normal values, but what was significant was that line was obliterated. Same point in time, it actually came back down to what we termed the 10-year uptrend, which was propelled or instigated in 2008, 2009. We've tested it multiple times throughout 2012, 2015, and on, and it's always projected the market higher. This 2020, coupled with the downtrend that we're in, is that day of reckoning that we state will be likely held first quarter of 2020 when these two divergent trends meet. So that big shot down was literally buoyed or bolstered back up based on that 10-year uptrend. And it jumped like a scared cat, because that's how powerful these technical indicating lines are. That's how powerful it was to break the market and send it hurtling down. At the same token, saying, yo, we're not breaking the 10-year uptrend with this momentum. We're going back up, and we'll do this fight at a later point in time when these two armies, if you will, of a bear and a bull will meet likely in the first quarter of 2020.
Right. So until the first quarter of 2020, what do we expect to see? Just general volatility, or is there going to be some reliable trends until then? Yeah,
here's the other interesting factor as well, right? I mean, I think as you stated in the properly worded commercial right off the cuff, which is impressive. Not all markets are equal, right? So what we speak about here is the Greater Vancouver average prices, average sales, all these kinds of indicating points. For a Port Coquitlam, for a West Vancouver, they all have their unique and individual trends and whatnot, right? So, I mean, that's obviously discernible to our client base. But getting back to the overall market, it's not what it used to be. And what will it become here over the next 6 months is probably somewhere in between the both, right? I mean, you will have the new inventory that comes up, and you'll have the seller that's approved for a price point. And they've waited for a while because of that stress test. And now properties are starting to enter into their snack bracket because some areas have dropped harder than other areas, right?
Yeah.
And so that's a real life question. Do you buy now because you can afford? It depends on your personal circumstance, right? What's your real modus operandi? Is it to get the absolute best bang for your dollar? Then more than likely it's hold off, and for a prolonged period of time here coming up, whether that's 6 months or the couple of years. It really does vary on the individual area, but I don't see it really blowing the market right out of the water down to 1.4 before the end of this year, truthfully. I mean, it very well could happen, and that's what we kind of we love about the market. We prognosticate it. We set it up technically or analytically speaking, and then the market actually bounces off the lines that it creates based on the market's own volition. So it's all about being able to identify these trends that the market set up for themselves. So when the market decides, it's a real unique and pretty interesting thing to watch or to see transpire.
Okay, cool. And this is a nice segue into the rent versus own debate. So
actually, just before we get into that, I just want to touch on the inventory levels as well, mixed in with those sales numbers, and that kind of how we get to that still somewhat seemingly basing of a market, right? Because you're getting newer inventory and you saw a little bit of a bump in sales. So what happens here in the next month, it's still a good time, you'll see properly priced listings come on the market, but not every listing is a properly priced listing at the ever increasing lowering price, right? Mm-hmm. So that will actually continue to build up the inventory to such levels that competition really starts to ramp up. And you still have a segment of the buyers, but it's nothing in comparison to the continual evolution of the new inventory market. By 2021 in the detached market, that inventory levels, they'll be right back up to peak levels. By 2021, guaranteed 2022, in the condo market, we're seeing peak levels. And that's really the catalyst between the supply demand, right? And I mean, as we know, as we've spoken about before, but the interesting thing is, yes, the sales numbers were good, but that's a 1 month indicator, and it's still well within our downtrend, our conservative downtrend, and the inventory hasn't changed from the strong uptrend that has been created basically since we based out in December of 2015 with the detached inventory sitting at 2,800. Now we're back up to 6,700, right around normal levels for a normal market, and that's why it seems like it's basing, is because this feels somewhat normal. But if you take it from where we were to where we're going, this is just a short-term pause in a market symptom that has a flu-like contagion. I mean, we're going further to inventory being high, sales continually being at low levels, not anywhere near to our 2,200 sales that you mentioned earlier. Mm-hmm. I mean, we're well off that. So a 1,300 sale month might seem good, but not when you have 8,000 listings, comparative to when you had 2,200 sales and only seemingly 3,000 listings. And that's why that market was so frenzied. A new listing was finding a jackpot. And so the buyers were lined up out front. Here's my bid. Mm-hmm. Now it's, you hold the open house and you'll see one of those dust bunnies roll by, right? The tumbleweed.
Yeah, for sure. So with the elevated inventory, and if the sellers aren't getting the prices or the offers that they want, are they actually going to start resorting to the rental market and saying, this market kind of sucks for me right now? I might as well try and make some income off this in the meantime.
That would definitely be the technical term I would use. Would be sucks.
For sure. Yeah.
Yes, it is. And that's why we were quoted in Inman Publishing as well in the New York article. About the college kids renting out luxury properties and things of that nature, right? I mean, you have to start to be creative, and we work with realtors, and I was speaking with one gentleman that's been through a few market cycles, mm-hmm. and the idea or the notion of trading properties just isn't a thing. Mm-hmm. But you watch and these kind of unique real estate dealings will become a realization again, because it's going to be a difficult market. So then you start to have to be creative, right? Mm-hmm. So is renting out the property the first part of creativity? Absolutely, right? So I mean, yes, you're going to be renting out properties and trying to mitigate or at least know what your risk level is. So I got this property leased to a lovely family for 2 years. I know what my rental income is going to be versus my mortgage costs. If you've owned for, over the past decade, you're pretty safe, right? But if you've bought in a couple years ago, like, you really should be starting to pay attention and maybe get a forecast from us, and we'll let you know what it looks like. And, just kind of going back to market before we get into that rental situation, I'd rather know there's a problem or there's a train coming down the track rather than being completely blindsided by it. And that's kind of how we equate this market. There will be chaos. There will be bedlam. We don't mean to be apocalyptic, but that's what the reality will become. We're actually just giving guidance that this chaosness will occur. Right. Likely in 2021 for the detached, 2022 will be ravenous for the condos. So, do you rent? Do you buy? It really does depend on your modus operandi, your personal circumstance. If you can buy,
sorry, Dane, can I interrupt? Because I really want to tell an anecdote that is that's a perfect setup for, I think, what you're about to say. So, recently, as you know, I moved into a new apartment with my partner, and you were gracious enough to help us move.
You got it, buddy.
And what was shocking to me in that process was how easy it was to find a nice rental property for a pretty good price. I didn't feel like I got a steal on the market, but, everybody knows these stories, right? About 10 years ago, I used to live in Kitts. Then I moved downtown, and when I was looking for places downtown, I'd look at 4 or 5 places, and before I can even send in my application, right, 3 other people would bid $200 a month higher than I was willing to pay. And, before I even sent in my application, I didn't even have a shot at buying a place.
Right.
This time around, I looked at 6 places. The prices were fairly reasonable. They weren't as low as I thought.
There was no steals, though.
There were no steals, but I saw every single one of them, and I was the first choice. And in fact, the people who were showing me the places were calling me the next day saying, right, "Hey, are you going to send in an application?" So right, that just reeked of desperation to me. And granted, I'm a working professional. I'm good looking. I'm a quiet
I didn't mean to laugh that hard. You are good looking, buddy.
Exactly. So of course I'm an ideal tenant. But,
right.
But what's going on there? Is the rental market juicy for people who are looking?
Okay, so here's the interesting thing about another interesting effect of real estate in Greater Vancouver and kind of the economy here in Greater Vancouver, BC overall. As real estate goes, so does the economy, it seems, right? So during 2015-16, everybody was flush with cash. And so, you're trying to move up continuously, and real estate prices maybe were out to lunch for purchasing, but you still had to live in a nice spot. And there was no vacancy, taxation, or any of that. So the landlords, plus they had rising values. So some of them wanted to cash out, and then you got forced out of your property, right? Like, you got a free month rent, and everything was above board, but they were willing to cash out. So that caused a bit more extra frenzy in that condo rental market, especially downtown, right? Because everyone was moving, buying, selling, flipping, trading. It was crazy. So that had a ripple effect on the tenants.
Right.
Now, what the landlords are the people that are saying, I'm either going to stick it out and ride this storm out, which totally fine and fair, or those that say, I bought it the wrong time, so I want to see what I can get and get a good professional in that's not going to move every 6 months, someone like yourself or like a lot of people that do, apply for downtown. Those are the guys that are getting selected. Definitely not the college kids, kind of going back, right? Because that's guaranteed for 10 months and then they're gone. Then I got to do the whole process again. Right. I'd rather try to get a good tenant at a realistic price so that I keep him happy. He pays the rent, all of these kinds of things, and it's just making life stable during this kind of chaotic event that's upcoming. So yes, and then so where does it go? Do I want to buy? Do I want to rent? Well, it's you know what I mean. It depends on the area and again your modus operandi, right? But chances are you will have a better. If you had $1 to spend, it will go further in the real estate market later on as we go further closer to 2022, especially for the condo market. Now, why is that? You live there. All the construction that was going on and all the multiple bidding that was going on during 2016-17, right? Mm-hmm. For properties that were for pre-sale, not built, just totally on spec, sold. And investors, that was the complaint at the time. It's not fair for us locals because these investors just bought 6, 7, 8 of them. Now, usually the deposit's anywhere between 15 and 20%. That was during the peak of the market, where the condo market was selling at average sale price of $750,000, right? Since then, we're down to roughly $650,000, so $100,000 loss, and we're going down to roughly 525, maybe 500. So there's a significant portion coming up of future loss,
right?
Roughly between 30 and 33%, right?
Yeah.
So if I'm that investor that has $100,000 out of deposits, but I got to put up another $1 million to complete on those, I might just very well walk away from my deposit and say, you know what, developer, sell them again, right. And then you're going to have that loaded amount of inventory available. Right. Of new condo market. That, I mean, and at that point in time, the buyers are going to go, well, I don't want to buy because it's going to be lower. Fair enough. So it becomes that self-fulfilling prophecy of this market where it used to be so good, now it's so bad, I don't want to even put my foot into it.
Right.
When that's transpiring with the new condos, what's happening to the 12, 13-year-old condo that's trying to sell? Absolutely zero activity. Right. So the resale market is going to be hugely affected, and that's how I term it, the cannibalization of the condo market that will be upcoming. If you're an older condo, you have to slash your price to be lower than the new condo. Even though your square footage is bigger, there's no warranty in it, so I mean, it's a different trade-off, and peace of mind usually tends to lean towards warranties rather than square footage.
Right.
Until you get into, you know what, the price-cost differential is so great that I'll take maybe a possible levy in the next 10 years rather than a 10-year worry-free living in a new condo in a small square footage space. So you'll have these opportunities to kind of choose which one you want if you stay in the rental market. Now, we've had a client that reached out and has that itch, has the exact itch you're talking about. The market's down. They can afford to buy in a nice area and seemingly with a lot of inventory. Should they do it? Well, do you want to do it, or do you want to wait and get a similar type of property at a lower price? Granted, that property is going to be gone because it's the 5 that we've seen is our nicer properties, so they will all be sold, and it's kind of a weird dichotomy because our clients know where the prices in this individual area will be, but of course they want to buy it for that today. Right, well, that's not fair to the sellers. Of course, they're not going to take a total discounted loss when the total discounted loss isn't a realization, right? So it's if you are buying, please be realistic towards the sellers. Please be realistic. Like, you're not paying peak prices. You're getting the inventory, and it's buying for a reason. It's buying because I want to pay my mortgage, start that process. I'm qualified. I'm ready to move in and be in the home ownership. It's an okay time, especially with those type of clients. Usually have a 7 to a 10-year outlook, whereas investors, it's where's my buck? And those guys, it's really, of course, buy the report, buy the membership, but hold off.
Right. Okay, well, Dane, there's kind of good and bad news. The bad news is that we tried to make this podcast 20 minutes, but we're way over it. But the good news is we did it because this is just so much fun. Right?
You got it, think, and hopefully it was educational, and they had a little bit of fun listening as well. Yeah,
that's right. And for full disclosure, I am an Eitel Insights client, and I've made my decisions regarding rentals and owning based on the information I've gotten. So just so everyone is aware, that is where I'm coming from. We will have episode number 4 for you fairly soon. We'll get on it ASAP. Thank you again for your attention, for your interest. This is always a blast to get to hang out with you, Dane, and talk about topics that interest us.
For sure.
And again, I'm Andy Park, your podcast host. This is Dane Eitel. Please visit eitelinsights.com.